All right, let's put on our detective hats for this daily brief. The markets have been, well, pretty turbulent lately, and we're going to dig in and find out exactly what's going on. So, what's the big question on everyone's mind? Why are key markets like the Nasdaq and Bitcoin suddenly feeling all this pressure? I mean, everything from tech stocks to crypto seems to have a serious case of the jitters. Let's start right there, at the scene of the incident. Our investigation almost immediately points to a single primary suspect, and it's a big one: the case of the missing billions. We're talking about a massive, and I mean massive, and sudden disappearance of cash right from the U.S. financial system. This isn't just pocket change. This is a huge withdrawal that's sending ripples through everything. And here is the smoking gun, the crucial piece of evidence. Get ready for this number: $147 billion. That's how much money was yanked out of U.S. bank reserves. Think of that as the essential fuel that powers the entire market engine, and someone just siphoned out a huge amount. Now, to put that into perspective, that's nearly 6% of the total bank reserves drained in just 2 weeks. I mean, the sheer scale and speed of this is just wild. That is more than enough to slam the brakes on pretty much any market rally. And this wasn't a slow leak either. It unfolded with incredible speed. You can see the timeline here. It all starts on January 14th. Then, bam, by the 21st, $94 billion is gone. And just a week later, another $53 billion is pulled. This all happened in 2 giant waves, creating a huge liquidity shock that the markets just didn't have time to prepare for. So, okay, with that much cash suddenly gone, the next obvious question is, how bad is the damage? Is the financial system showing signs of some real structural injury? We have to check its vital signs. Is this a serious, lasting wound or just a temporary bruise? So that's exactly what we did. We ran a sort of market health check, a series of quick diagnostic tests on the most sensitive parts of the system: money markets, high-yield bonds, that sort of thing, really looking for any cracks under the surface. So what's the verdict? Okay, first up, money market tension. This is where banks lend to each other for really short periods, like overnight. And yeah, we're seeing some elevated stress here. Things are a little tense. But, and this is the key part, it's not in the danger zone. No red alarms are flashing. So a little shaky, but holding. All right, next, what about high-yield bonds? The riskier corporate debt. Well, the risk is contained. Investors are asking for a little more money to hold these bonds, which makes sense, but they aren't panicking. We're not seeing a new uptrend in risk premiums, and they haven't broken through any key technical levels that would really signal a crisis of confidence. So, what's the overall diagnosis? Basically, no structural damage found. And that's the crucial takeaway here. The system definitely felt that punch. I mean, $147 billion is a hard hit. But it's not broken. These look like temporary tensions, not the beginning of some big systemic crisis. But, a good detective never closes the case after finding just one suspect. We've got to uncover all the clues. And it turns out, while that liquidity drain is our main culprit, there are other forces shaping the market right now. Okay, first clue, and this is a big one, especially for the tech sector: the SpaceX IPO. This thing is so massive that it's forcing funds to sell off other tech stocks just to make room. Think about it. Big-time investment managers are cashing in on some of their current winners, all to raise the cash they need to buy into this new giant when it hits the market. And what's really interesting is that this whole shuffle is being helped along by Nasdaq's new fast track rule. It almost seems like it was tailor-made for a company like SpaceX. So a massive company like this debuts on the stock market, Nasdaq applies its new rule, and boom, within just 15 days, it can join major indexes like the Nasdaq 100. That then forces all those passive index funds to buy the stock, which just adds to the pressure on them to sell something else. Now, for our second clue, we have to look across the globe, because at the same time all this is happening, China is actually injecting liquidity into its system. Their central bank is pumping in cash, which is providing a partial cushion for the global markets. It's helping to offset some of that tightness we're seeing, which honestly is probably preventing a much worse outcome. Okay, let's switch gears and do a little case study on Bitcoin, because this is one of the areas that's been hit really hard. And our investigation uncovers this fascinating story. A tale of 2 markets, really. The recent price drop here is way more complex than it looks on the surface. To really get what's going on, you have to think of Bitcoin as 2 totally separate things right now.
On one hand, you've got spot Bitcoin. We're talking the actual coins. And the data from the blockchain shows that long-term believers are holding on tight. They are not selling. But then on the other hand, you have paper Bitcoin. This is the world of futures and derivatives, and that is where all the recent selling pressure is coming from.
And this leads to a really fascinating theory that the evidence seems to support. The quote says it all. The decline is led by futures, by someone who does not have spot. So think about what that means. It suggests that large investors who don't even own Bitcoin are using that paper market to push the price down. And why would they do that? Well, the theory is they're hoping to cause a panic so they can swoop in and buy the real thing, the spot coins, at a huge discount from people who get scared and sell. So if we look at the key technical levels for Bitcoin, the story gets even more interesting. Right now, the bears, the sellers, are in control as long as the price stays below $72,000. But, and this is a big but, all of that heavy selling in the futures market, all those short positions, has basically created a giant coiled spring. It sets the stage for what's called a potential squeeze. If the price rebounds sharply, all those short sellers could be forced to buy back in, which could fuel a massive rally.
All right, so we've looked at all the evidence. From the missing billions to the SpaceX IPO to the paper trail in crypto. So, what's the verdict? What did our investigation conclude?
Well, here's the summary of our findings. First, the market got hit by a really powerful but short-term liquidity shock. The good news? There is no evidence of lasting structural damage to the financial system. Meanwhile, the Nasdaq is feeling specific pressure from funds getting ready for that huge SpaceX IPO. And Bitcoin's drop? It's a really complex battle between the long-term holders and the short-term paper traders. So in short, the market isn't fundamentally broken, but it's definitely been rattled.
And that leaves us with one final, pretty provocative question to chew on. As the market absorbs this liquidity shock and the dust starts to settle, is the next big move going to be decided by paper contracts and leveraged bets, or by the physical conviction of those who are holding the actual assets for the long haul? That's the real tug of war happening right now.